Hey there, and welcome to the show. My name is Michael Blank. I'll be your host today. Super excited you're here to learn about apartment building investing, the single best way to achieve financial freedom. And what I love about this business, there's so many different ways to achieve the same thing, which is financial freedom. You can be an active investor, you can be a passive investor, and or you could be a little bit of both. And so today on the show we have Raj Tekchandani, who basically started off doing some active investing like so many of us do, buy a condo and a house here. It kind of gets the bug and invests passively and gets so excited about it that he starts telling his friends, and before you know it, he's raising money and joint venturing with other multifamily syndicators. Such an awesome journey. He's going to talk about that journey, and his background is high tech. He's got a background in artificial intelligence and high tech. And that's also the kind of investor he focuses on, is people with high-tech background. They really relate with him. So he's going to go through and talk about his journey. Why did he start investing in real estate? What was wrong with the stock market? And on that note, I just want to let you know, we just put out a new report that basically compares the stock market with real estate investing, specifically syndications. That report is at themichaelblank.com/report. It's a great tool because it kind of analyzes what's wrong with the stock market. The returns you actually think you're getting in the stock market is actually not what you're really netting at the end of the day, for a variety of reasons that I outline in the report. And then, of course, I argue why multifamily syndications is a fix for all that. So it might be great if you're considering investing some money out of the stock market. This would be a great tool for you as well. If you're an active investor and you're raising money from passive investors, it might be a good thing to know in that report. So it's the michaelblank.com/report. Anyway, back to Raj. Let's get right in the interview with Raj. Here we go. Raj, welcome to the show.
Hey, thank you, Michael. Thank you.
I'm super excited because you're going to give us the blueprint to quitting your job in the next 30 minutes or so. And that's going to be really cool. And what I love about this business is there's so many different ways to achieve the same goal, which is financial freedom. And you have a unique path, as most people do. So I want to kind of drill down on that a little bit. Wind back the clock a little bit and describe when you got started with real estate. What was going on in your life, and why were you thinking, hey, I think I'm going to use real estate, and maybe one day I can quit my job? Like, what was going on when you were thinking when you got started with real estate?
So, Michael, background, just like yours, is technology. For people who know, technology jobs are, there's nothing, goes for long term, especially startups that I'm very fond of. We can hit a home run, or we can, strike out pretty quickly in startups.
Yes, right.
So, so clearly, I in my back of my mind is like, okay, I'm continuing to work on my startup path, but somewhere along the long road, I want to, create a, second income stream and see if I can, make that as, passive cash flow alongside my W-2 income. So that was the initial thought. Had not done much about research on what, how, where, but that was the thought.
And so that was the thought that, hey, you build up this passive income, right? Just on the side. And so what did you start doing?
So back then, this was now circa 2012, a friend of mine was buying, properties in Orlando, and I don't know how he was doing it. He was, he bought a few condos. I said, what's going on? So he said, come down with me. So I went down there and looked at the condo prices. These were like decent condos, and they were priced very low. So I said, oh, that's not a bad idea to jump in. So I bought my first condo for $34,500, which I was told the price at some point at peak was about $180,000 for those condos. So I said, this is not bad. So I took that little leap of faith, wasn't much more of a risk at that time. And lo and behold, it started giving cash flow, and I bought another one and got sort of hooked on to this idea of passive cash flow.
So did you have a property manager manage these condos for you at the time, or how were you managing that?
Yeah, no, fortunately we had a property manager, and she's still managing it for us, that same property manager. She lives in the same apartment complex that these condos were in. So that was a great help of, investing, out of state for us.
So you started investing in condos because, hey, you felt like the passive income was kind of nice to complement your job. You bought one. That was pretty cool. You bought another. At one point, did you start to think that there was maybe a greater strategy behind what you were doing?
So it was about 2015. Now I had assembled probably 9 condos at that point. And unfortunately, our property manager, the old lady, she passed away.
Hmm.
And I was like, holy cow, now what do I do? And fortunately for us, her daughter stepped in and, took charge. But that gave me a pause to think, hey, I'm investing too far, too many different, properties, too many bills to manage, too many, checks to collect. I would probably look at something called multifamily, which I had heard about. And I said, okay, let's do multifamily closer to home so I can keep a good watch at it and I can get more involved. And that was the, pause that led me from the single family condos to my first multifamily investment in 2016.
So why did you go to a multifamily? You could have just started buying maybe townhouses or condos, in the Boston area where you're from. Well, why did you make that shift?
Oh, well, I think clearly, so I had read about this now, a little more intelligent than I was before. The whole economies of scale and, managing under one roof and, the whole idea about, if we have, couple of, units vacant, I can still survive. The whole idea of the benefits of multifamily, were kicking in to see, okay, let's do something larger and bigger. But at that time, I was not ready for anything bigger than what I bought, which was, a decent sized apartment in the Boston area.
What was the first a multifamily that you did?
So this was a 15 unit. It's like 12 residential and 3 storage units in a neighborhood near me where I live. So just drove down the street and I saw that on LoopNet. It was available. I was like, this area is not the best area. I wouldn't live in that area, but I would definitely, because it's a neighboring area. I know a lot about it. It's up and coming. It's it's bordering our town, and I could see that the property was on just across the town line and had potential in that particular street or part of the town.
So it was a 15 unit. Where was your comfort zone at the time? Was it 15 units? Was it 25 units? Was it more like, were you freaking out? Like where was your state of mind at the time?
So it was definitely something, 15 unit where I had my down payment was, at that time, $250,000 or so. This was $1 million purchase, that one, just short of $1 million with some. So that was my comfort level. And I was like, if I have to do this, so let me just get in at this stage.
Well, how did that first deal go? Was it smooth? Was it some hiccups?
Oh, absolute hiccups. So it was little that I learned that, there's a difference between the real difference between passive and active investment, right? So if you're still owning that property and you're still, even though your property manager is managing it, it's still active involvement, because if you're not actively involved, things can fall apart. And the property manager that I had was not working out because he was actually the son of the owner, which, I found out later in the process. So a lot of expenses that were not on the T-Trails. And, I didn't have the Michael Blanc's STA back then to say, okay, 30%, expense ratio is a big red flag on a Class C property. So all those things, I learned along the way. But the good thing was the occupancy was, 100% when I got it, which slowly fell apart. The rents were, rents were not coming on time because the previous property manager was just letting it go. He didn't care whether the rents come in on the 1st or the 15th or the 29th. So a lot of that, turned out to be a nightmare, plus added, a bunch of expenses that we didn't know, the snow plowing expenses. He was doing it himself. And lo and behold, that year it snowed a lot. And these are not, you pay somebody $35 to, remove your driveway snow. These are expenses that pile up pretty quickly.
Did you have to fire your property manager?
Yes, I did eventually. I said, this is not working out clearly, or not interested. So we parted ways, and I found, scrambled to find another property manager, and that didn't work out. And finally now, after 2 years, a lot of, lost rent and all that thing, we're getting the property back on track.
And it took a while.
It took a while. Yeah.
Yeah. I think there's a little myth out there that this is there is passive investing. I don't call it passive investing. I call it, leverage investing. I think
right,
more so than many things, but now and I know that the quality of your life depends significantly on the quality of your property manager.
Absolutely. No question about it.
Like, for example, how much time were you spending on this 15-unit property back then, and how much are you spending on it now?
I am not spending any time now, fortunately. And back then I was going there 3 times a week just to figure out what's going on. I went to courts a couple of times for evictions and all that stuff that it was a mess. And our vacancy went down, our collections went down. I mean, I learned the big difference between economic occupancy and physical occupancy, right? You can have people staying in your property but not paying you. So that was the case when we first took over the charge.
So the first deal was not an easy one. What did you do after that, and when did you do it? So this was sometime in 2016. What did you do after that?
2016. So alongside, I was reading about something called syndication, multifamily syndication. I had a friend who was involved in syndication. He offered me, he showed me a property package, some 200 something units in Georgia, and he said, "This is the way you do passive." I said, "I don't get it. There were too many zeros for my liking, right?" It was, it was a large property, and the numbers looked very big. I said, "I'm not ready for this." And he said to me at that time, "What you're doing in your 15 unit is more riskier than what you're going to do here." And I said, "I don't believe it, but well, we'll talk." So I did, but I continued my education on multifamily syndication. Read books, listened to every podcast there was, and somewhere down the road of 2016, I invested passively in the 151 unit in Georgia. And that by that time, I had a good comfort level of what passive investment and what do I want to do with passive investments. I really am not a handy person, so I don't want to be managing properties. I knew that what all roles are there in the whole syndication, and that's how I got started. And there was a clear path for me saying that if I do a few more of these, and that is clearly a way to financial freedom for me. If not financial freedom, at least freedom of time for me.
So you got to experience what it's like to be a limited partner, a passive investor, which probably was fairly passive.
Mm-hmm. That was fairly passive.
Yeah. And how did it go? I mean, what do the returns look like compared to, what you were doing with your own 15 unit?
I mean, returns were, good. The returns were like this property was IRR 18% or more, or I think 18 point something. The cash flow has been about 10%, cash on cash, I mean. So far it's doing good. I mean, it's been doing well. And for my property, at that same time, it's really hard for me to compare because my property took a dip. I don't know if you heard the news back then. There was like the Columbia gas explosions that happened in that same town. And we were running at 50% vacancy. So I will get a good measure of, what my cash flow there is in a couple of months when we get fully, leased up to compare to, the other option. But I'm keeping it around because I have the belief that the property values, and the property value is already gone up. So I knew the concept of forced appreciation. Right now, when we took over, the average rents were about $850. Now we are renting them at 1,200 plus on the same units.
Yeah, you've built a lot of equity. So now you know the joys of passive versus active income investing.
Right.
So at one point, did you quit your job here? When did this happen?
So once I got very comfortable with the idea of passive investing, and I saw the cash flow that was coming in from my condos and the potential cash flows that could come in from my multifamily unit, is when I decided to say, okay, I'm going to do, if not syndication, more passive. So my plan was to do more passive investing and buy another one of these 25, 50 unit property, because now I was much more confident. And I said, I can do this full time now. I was not ready to go back to another startup because, really startup is a long shot of, you can make it or break it. The salaries in startup are not that great, as you know, Michael. But really it's a stock option betting game. And so I decided, I'm going to do this full time. I can control my own destiny in some way or sorts to do this full time. And that was a leap of faith again I took to do that.
Yeah, I would agree. It's definitely a leap of faith. And I concluded the same thing. I knew I got pretty lucky with the IPO that we had at Web Methods. Just on looking at everybody else, and even getting bought was, a remote. And meanwhile, you're working 65 hours a week on something that is most likely not going to happen. Nevertheless, though, I got to say, Raj, the idea of getting a job with a salary, why did you not? I mean, it was a leap of faith. Why did you think it was worth it? In other words, what if you had gone back to a high-tech job? What is it that you did not appeal to you?
The control on my own time, right? I mean, now I probably work more, but I work at my will, right? So, I mean, we had management meetings at, Friday, late evenings, and it was just one of those things that, you got to do what, the company wants you to do. Yeah, I mean, the stock options would have been nice, but I mean, it's a lot of grind on somebody else's idea,
And
unless
you
you start your own company. Yeah.
and you think and so your experience that you had up to that point gave you confidence that if you focus on this thing, it'll be okay.
Yes, I did. I did. And I had also a passion of, my passion for technology continued. And I said, I looked at, we'll probably jump into that later part of, why technology and all that stuff. And I was looking at, I can continue my passion on technology tools, on data analytics, and bring them over to the real estate arena and still, get my intellectual, whatever you call it, stimulus, and still do things at my own will, and probably put in more hours and more energy, but something that I enjoyed more than going for another startup or full-time job.
Yeah, that's awesome. What was can you remember back your last day of work? Like, what was that like for you?
It was nervousness. It was, okay, where do I go from here? I mean, who do I talk to? Suddenly, you don't have any place to go to and, talk to different people and bounce around ideas. So it was a little vacuum that I saw, but that quickly got filled because I took up a space in, one of those co-working spaces that I, took on, and I could still talk to people. And interestingly, that turned out to be great because now you're bouncing off ideas of, to people who could be potential passive investors.
Yeah, that's right. So you quit your job and then now you're focusing on this full time. Kind of what did you do since then?
So continued my path. So yeah, since then I did more research on doing another property in the Massachusetts area. Quickly figured out that's the number's not going to work, and if I'm going to raise some capital to do this, the returns that I've seen in other parts of the country are not here. So I said, okay, what do I do now? So clearly, I circled back with the investor, the syndicator that 2-3 years ago I had refused the deal for. I said, I'm not ready yet. I went back to that team and I said, you know what? I think I'm going to do this more actively, and tell me how I can get involved. So idea of, doing more syndications and dropping the idea of finding something locally, small units, I dropped that idea and became a full-time, evangelist for syndication, multifamily, and all that good stuff.
Did you go out and find your own deals, or did you partner with syndicators who had deals and you raised money, or what was your strategy from that point forward?
So my strategy to jump into this was to, work with a team that had, a good track record. Because that was only for my passive investments at that time, but the idea of capital raising came a little later when I said, oh, this is great. And, I saw people around me not knowing what syndication is, and everybody's invested in stock markets. And, every time the market goes down, they're like holding their heads. And I was like, I started, so I just, just like I said, I started evangelizing the whole idea of multifamily syndication and still partnering with, people that I knew to get it started.
That's great. So you have experienced operators who are finding deals and operating deals, and you're partnering to raise money. What is it? What is it that makes you so excited about raising money for multifamily? What is it? Why are you so excited about that? I'm excited about it also. I just want to hear, why are you excited about it?
I think it's the notion of, this thing requires education, and this thing requires meeting people. This thing requires, the passion that you can, transfer to other people that are still not aware of what it does. So that was part of it. I was meeting people. I started a meetup group and all that stuff. All that good stuff came along. But it was the passion of me trying to explain this concept of multifamily syndication to people. And some of them really got it quickly, and some of them I'm still trying to convince, that this is the next best thing. So that was the main idea about that.
You talked about that you have a passion also for technology. How have you combined that passion for technology with your investing?
So clearly, Michael, when we say about capital raising, I'm not just, a capital raiser. So I still, do my own underwriting and, look at deals very passionately. So the technology piece comes in multiple aspects, actually. There is a lot of research. So when I left my W-2, I was into this machine learning AI stuff kind of work. And I realized that there's a lot of machine learning AI stuff happening in the real estate as well. So I met up with, a colleague from MIT who had done a whole thesis on, basically artificial intelligence in real estate. And I sat with her and understood, where the market status is of, all the companies, and learned a lot about, different kind of companies. And few companies that, clicked to me were, companies like Rionomi, Inodo, that were doing stuff in the space that I was interested in. So finding deals, underwriting deals, market analysis. So you can take all the technology tools, because, I still call it, everything is decision data-based, decision making, right? Data driven. So a lot of real estate or pharma or whatever that we have, the underlying data is the key to, making good decisions. So quickly realize that there is tools out there that are doing things in a much smarter way, or are trying to do things in a much smarter way. And I said, okay, this is interesting. So I'll blend technology tools in my interest of, underwriting or market analysis. And then more tools came by later too, which I can talk about.
Well, let's talk about some of that stuff. So you are a capital raiser, but you also really appreciate the underwriting, and I think that's what your investors appreciate about you, is that you actually get really into these deals and you're underwriting deals. You're asking questions. Now, what kind of technology are you using? And I think what you're describing here is something that any active investor, and I consider you, when you're capital raising, you're an active investor.
Oh yeah.
What kind of tools have you found useful?
So early on, when I said, okay, I'm going to go find my own deals, right? And I started networking with brokers and all that good stuff. I used Rionomi a lot. Rionomi is, again, if you go to their website, they'll claim they are the best AI artificial intelligence tool in real estate. But they do some good stuff. They collect all the data on existing apartments. You can figure out which loans are coming out to be, in the next quarter or so, who owns it, what does the property look like, and all that good stuff. So there's a lot of data on apartment ownership. So you can quickly, find those data and go to the owners directly without, it's like off-market deals, But like I said, the Rionomi is still working on a lot of data that is coming up in certain areas. I mean, they're doing well in certain areas, but the areas that we were looking at, so that was one tool that we explored a lot, but didn't make any purchases based on that.
What else?
Then there's like tools like Inodo, right? I mean, Inodo, what it does is it takes, Inodo is a blessing in for us who, don't want to take, time multiple days in underwriting, right? Inodo, will take you give it, a PDF of, T12s or rent roll or whatever expenses you have. Inodo software just takes it in and it, ingests all the data, and it'll spit out, a pro forma for you or analysis for you for, doing these underwriting stuff. And not only that, Inodo will, because it's a machine learning tool, has built-in intelligence to go out in the neighborhoods that you are looking at the property for and say, the rents in this property, are they matching with the similar kind of rents in the neighborhood? So that's very powerful.
And how reliable or consistent is that data that you're finding?
It's I would still always go back to, feet on in all these technology tools. I keep saying that there are good tools, but you can't 100% rely on them. You still have to rely. And one day the day will come that these tools will get, very reliable, but they're getting there because it's all learning. The machines are still learning. The data is being accumulated every, hour. The property management software databases are being updated. So a day will come that we can make exact predictive analysis, but still right now we still do make sure that we have feet on the ground that doing actual comps analysis for us.
Okay, that's great. Any other technology that you found super useful?
I think we found some, proprietary tools that did, market analysis, because we have, a list of, criteria that we look at a market for. I mean, I have this list here. We look at population growth, net migration. So all that, the data is available publicly. We just have to find tools. And there are tools that are coming out there, and I'm working with, a couple of software companies in the Bay Area to build some of these tools, not there yet.
Yeah, that's fabulous. That's awesome. So it's interesting to observe that there are a good number of passive investors, not all of them, who transition into more of an active role like you've done. What is kind of your advice? So take someone on a journey from, hey, they have 100% of their assets invested in the stock market, to, investing passively in a deal, and then potentially becoming a capital raiser. Like what are each of those steps? Describe that, and maybe reference your own experience.
Right. So I think the first thing when I meet somebody, so like I said, I have these meetups that people, and it's an open forum meetup, and anybody can, it's a small meetup that anybody can come and ask questions, and we have follow-ups. So anybody who's new to, multifamily syndication, they would have follow-ups meeting with them. And the first question I ask is, what is your goal, right? What do you want to do? You want to be a real estate investor, but what kind of real estate investor do you want to be? Do you want to be an active investor? Yeah, I want to be an active investor. Do you know what active investing means? It means a lot of sleepless nights. And do you want to be a passive investor? What does that mean? Does that mean that you just blindly give your $50,000 check to somebody? That's not passive. That's blind investing. So, walk them through, what active means, what passive means, what they want to do. And if they want to pursue the syndication path, I give them the options of, my goal path. But not everybody wants to do that. And a lot of people say, I'm very happy with the job that I do, but I want a secondary, cash flow stream. So for them, it's not, they don't want to transition to being a capital raiser, but they want to trust in a partner. And they have found me to do that, to find deals for them that I have vetted through my technology background and my tools, and I'm going to be investing alongside, and to just passively invest. So those are the paths that they can choose.
Yeah, that's fabulous. So, what's your advice for someone who says, "Hey, Raj, this is really interesting to me. What are the steps that a passive investor should go through to become comfortable with investing with multifamily and with a specific operator?" When I say operator, I consider you kind of the operator, right? Because they're kind of investing you may be partnering with somebody, but they don't really know that person. So they're really partnering with you. So what do you do to get them comfortable with the asset class, and then with you, and then the deal?
So, yeah, I mean, I've been a lot of actively, putting out content on social media and all that in basically snippets of things that I, digestive amounts of, information that I can give out to passive investors. I mean, if somebody says, I want to invest, I give them definitions of what are the definitions you need to know, walk them through a deal that we have done in the recent past. And again, walk them through, hold their hand. It's sort of be like a concierge to them in terms of, walking them through their first deal. And if they say, no, I don't want to be really active, and then I walk them through different paths. I say, go get these tools, go get the, syndicated deal analyzer, go work on it, learn it, look at all the videos that are out there, get comfortable with underwriting a little bit, and do the market analysis. So there's two different paths. For the passive investors, yeah, I mean, there's a lot of education and trust that I build through meetups, through, blogs and content I put out. And I'm still writing a lot of content to put out.
Great. So you're actually educating the investor constantly with content and phone calls and meetups. So that's great. What do you look for in an operator? Well, before you align yourself with an operator, what do you look for?
I mean, clearly I look for operators that I know, sort of have known in the last few years, right? I mean, I don't go for the biggest bang operators that I've done, 10,000 units or what. I go with the operators that they're part of my masterminds, or I've met them through, other deals. And I like their working style. Operators that I can question anytime, and they'll pick up my phone anytime to answer any question that I have. So most of the operators that I worked, like I said, I've met them through, coaching club groups and masterminds, and I tend to, stick with them. That's my philosophy. Trusted partners.
Trusted partners, and you don't need a lot of them.
No, you don't need a lot of them. I mean, I don't need, a lot of them. I need a few who who have a solid understanding of where they're going, what markets they're going after. If we agree on that, that's where we start off with.
This is great. So you have a lot of great content out there. How can people find out more about you?
Well, I have a website, www.smartcapitalmgmt.com. That's smartcapitalmanagement.com. I mean, my email, raj@smartcapitalmanagement.com. There's a lot of content. I on Facebook. I run a couple of Facebook groups on, data-driven multifamily investing, and just general large Facebook groups just like that. So a lot of ways to find me.
That's great. And we'll put this in the show notes. It'll be themichaelblank.com/session177. So we mentioned a few technology items, so we'll put those in the show notes with links to those as well. Hey, Raj, thank you so much for being here, sharing your journey and your expertise on technology.
Michael, it's been a pleasure, and thanks for hosting me.
All right. So if you didn't have a chance to scribble all this stuff down that Raj was talking about, the show notes are themichaelblunt.com/session 177. And we'll have that in the show notes to talk about some of the technology things that he mentioned. Really super useful tools, and there are other ones out there. I think the takeaway is this: if you're raising money, then really figure out what your niche is, right? Like, who do you attract? We talked a lot about that Dealmaker Live a couple months ago. Is don't just go out there and try to raise money from everybody. Figure out what your niche is, right? So if you're a working mom money raiser, you might be attracting working mom or moms, right? If you're a high-tech guy, you might be attracting high-tech people. If you're an attorney, you might attract attorneys, a doctor, or doctors, okay? So figure out what is your niche and who are you going to attract? What do you have in common with? What is your story? And really figure out what that is. Conversely, really consider what you want to do, right? We talked a lot about the pros and cons of active investing. A lot of people feel like they need to or want to get into active investing when in fact, it's not actually what they want to do. They really want to be a passive investor. And honestly, the returns for a passive investor are really good, especially in relation to what you have to go through to become an active investor. The education, the experience, the amount of work you're doing. It's a great way to create something out of nothing as an active investor, but you got to be an entrepreneur true and true, and it's something you got to love doing. And if not, consider being a passive investor. So I agree with Raj that one of the things that we do a lot at Nighthawk Equity is really educating the investor, because a lot of people, they know something's wrong, not right with the stock market, and they're looking for alternatives. They hear about multifamily syndications and it intrigues them, but they don't know anything about it. So if that describes you, I invite you to kind of find more about Nighthawk Equity at nighthawkequity.com and click the join button. That puts you in our club essentially, and on our email list. And we're going to share with you how our process works, what the minimum investment is, how we buy property, what we look for. We'll also have a phone conversation with you to get to know a little better. So same with Raj, we want to make as many people comfortable investing in multifamily, number one, and with us, number two. So if that describes you, check out nighthawkequity.com/join. So again, so many ways to get involved. Active investor, passive investor, a mix as a capital raiser, and it's just so exciting. So thanks so much for being on the show today. I will catch you on the next episode. All right, I hope you enjoyed that. Now, as the next step, download this ebook right here, okay? When you've downloaded that, make sure you also subscribe to my YouTube channel, because then you can get all of the videos that I release as soon as I release. So make sure you subscribe to the YouTube channel right now. Click on that right now. And then also make sure that this is the next best video to watch, is this one right here. So hope you enjoyed that. I'll catch you next time.